Well, thanks everybody for coming here today, and for all the people who are listening to the live stream. The impetus for this event here in Washington, D.C. is Ben Bernanke, Chairman of the Federal Reserve, has just finished a four-part lecture series at George Washington University. How many people who are here were participating in that lecture series? By show of hands. All right, a few of you. Now, apparently it was sponsored by the economics department, but they had that wrong. See, they really should have sponsored his lecture through the drama department, because everything he said was just pure fantasy. Right? It was Ben Bernanke's distorted view of what actually happened. So what I wanted to do is set the record straight and actually speak about the facts. Not only the facts of the financial crisis and the Fed's key role in causing it and inflating the housing bubble, but go back to the beginning, the Federal Reserve's formation, because Ben Bernanke basically presented a completely revisionist view of history, not only recent history that we just lived through, but the history of the formation of the Fed and, most importantly, the Great Depression. And an interesting thing is Ben Bernanke fancies himself as a student of the Great Depression. But based on his presentation, if he was my student, he would have gotten an F. He doesn't understand anything about the Great Depression, and he doesn't understand anything about the financial crisis or the depression that either we're in or we're heading for. So what I want to do is I want to start off where Bernanke, I got a bunch of his slides, not all of his slides, because there's too many. We can't get them all into an hour. So we picked up some of the slides, and I'm going to put those slides up here and then just comment on them. And when I'm finished with all the slides, I'll talk about whatever I couldn't address with the slides until, you know, the hour was up. So he started off by talking about why do we have a central bank and why was it created. Of course, it was created in 1913, and according to Ben Bernanke, we needed this Federal Reserve because before the Federal Reserve, we didn't have any stability in the banking system. We had constant booms and busts, and he talked about some of the more famous panics that happened in the 19th century. And he said that we needed the Federal Reserve in order to do this. In fact, he talked about the banks as inherently being unstable in that they could be subjected to a run, because banks would take in deposits and they would loan them out. And what might happen to a bank if depositors wanted their money, but they couldn't get it because the banks had loaned it out. And so the whole idea is they'd have this lender of last resort that would be there, and that would make sure we didn't have bank runs and we didn't have all these panics. And so that's why we had the Federal Reserve. Now, what Ben Bernanke really didn't discuss is that the record of stability was better before we had the Fed than with it. In fact, the biggest busts and booms happened with the Federal Reserve, not without the Federal Reserve. And we weren't having constant runs on banks before we had a Federal Reserve. Yes, we did have bank failures in the Great Depression. And I'm going to get into the Fed's role and the government's role in creating that, you know, in a minute. But even with all of the bank failures in the Great Depression, only about 2% of deposits were actually lost. So it was a very small amount of deposits. I mean, we lose more than 2% of the value of our deposits every year now to inflation. So this is just a myth. And in fact, banks are just like any other business. Absent government intervention, banks are going to compete with one another based on reputation. Banks don't want to run. They don't want their customers worried about their deposits. So there is competition. Banks are going to hold adequate reserves so that their customers are not concerned and so that they can meet whatever demands might be placed upon them. This is what happens in a free market. The banker decides how much reserves am I going to keep, what am I going to loan out. What happens is when the government comes in with the FDIC and they have the Federal Reserve as this lender of last resort, now the banks have no market-based incentives to be prudent. It doesn't matter. They'll loan out as much as the government will let them, because now there's no concern, because their customers know that the government stands behind the deposits. So it's instability. By interjecting that moral hazard, by bringing the Fed in there and the FDIC, you actually destabilize the banking system because you removed all of the market safeguards that would have protected the banks. The banks would have kept adequate reserves because they knew their depositors would want that. But now with the Fed and the FDIC, we have a lot more lending and a lot more risk-taking on the part of the banks because the government has come in and created this moral hazard and created a situation where bank customers no longer care about the solvency of the banks. That is a big problem. So in fact, the Fed created the exact opposite of what Bernanke said. As he went into the creation of the Federal Reserve, he talked about the limitations of the gold standard because, of course, prior to the Federal Reserve, we were on a gold standard. Although when we created the Federal Reserve, we didn't leave the gold standard. We were still on the gold standard. In fact, Federal Reserve notes had to be backed 40% by gold, and the notes were still redeemable. So we were on a gold standard. It's just that we had the Federal Reserve issuing notes backed by gold as opposed to maybe independent banks that were issuing their own notes that were backed by gold. So we didn't leave the gold standard. You can say we modified it a bit. But Ben Bernanke was very critical of the gold standard. And his main criticism was that it took away the flexibility of government and bankers to try to micromanage the economy from Washington. Well, that's not what's wrong with it. That's its greatest virtue, is that it stops people from like Ben Bernanke or Alan Greenspan from destroying the economy. The whole idea that central bankers know more than the free market, that they know what interest rates should be. We have interest rates in America that are not set by the free market. In a gold standard, interest rates are set in the market. In the system we have now, we have central planners, like in the old Politburo in the Soviet Union, that sit around and try to guess what the appropriate rate of interest should be. And then they set that rate. And that's what we do now. And where does Bernanke have interest rates set? He's price fixed them at practically zero. The biggest problem with the U.S. economy is that interest rates are too low. The Fed is distorting the economy with these low interest rates. None of this would happen under a gold standard. We'd get the right interest rate because the price would be set in the free market. And you know that interest rates are too low because nobody is saving. We have all this debt and we have no savings because rates are too low. The market would bring rates up. Higher rates would encourage savings, would discourage borrowing and consumption, and we go back into equilibrium. But the Federal Reserve is there. If the gold standard was there, this couldn't happen. Another problem is with the deficits. Gold limits the ability of the government to spend beyond its means. But with the Federal Reserve, that's going to buy up government bonds and monetize the debt. Now they call it QE, but this allows the government to be fiscally irresponsible. Gold would rein in excess government spending. But with the Federal Reserve, there is nothing to rein in excess government spending, and that's why the government is able to spend so much. So it was the strengths of gold that Bernanke is actually criticizing, because Bernanke wants that power. He actually believes, and based on the evidence, I don't know how he can believe this, because the guy's never got anything right in his life, but somehow he thinks he's so much smarter. And so he thinks we're better off letting him make all these decisions than letting these decisions be made in the free market with real money, which was gold. And of course, we were in the gold standard. The founding fathers put us on the gold standard. And we really stayed on the gold standard in one form or another all the way until 1971. So to say that we went off the gold standard when we brought the Federal Reserve in is not the case. But we certainly changed it a bit. So here's where now he gets into the Great Depression. Okay, and this is where Ben Bernanke really goes off the deep end in his historical account of the Great Depression. But before I even talk about the Great Depression, I want to talk about the depression that Bernanke didn't even mention because it doesn't fit into his narrative. And that's the one we had in 1920. Now, a lot of people don't know about this depression because it was over very quickly. But it began for the same reasons that the Depression of 1929 began. Right? We had a stock market that collapsed. In 1920, stock market dropped by about 40% in 1 year, the Dow. The GDP collapsed by 17% in a single year, 17%. And unemployment skyrocketed from 4% to 12% in 1 year. And why did this happen? Well, World War I started in 1917. The Federal Reserve was created in 1913. When we entered the war, of course, no, the war didn't start in 1917. That's when we entered it. When we entered the war, the government wanted to help pay for the war by borrowing money. And it wanted to borrow from the Fed. But there was a problem. You see, the original Federal Reserve Act, it prohibited the Federal Reserve from owning any U.S. treasuries. And that made a lot of sense because they didn't want the Federal Reserve to own treasuries because they didn't want it to be an engine of inflation. They didn't want the Federal Reserve to lend money to the government or buy government bonds. So it wasn't allowed to do it. So they went in and they amended the act. to allow for it, which shows you how dangerous this was. It was, like classic, you get the camel's nose under the tent. So they put it in with that restriction, and then a few years later, they took it away. And it's also an interesting bit of trivia. When they did that, that's when they first came up with the idea of the debt ceiling. Now, we're always talking about the debt ceiling now. Well, that's when it started. When the Federal Reserve was given the power to buy bonds, Treasury bonds, people were concerned. Well, this could be very dangerous. This could really lead to a lot of debt. So they decided to put a limit on how much debt the Treasury could have, now that they made it easier for the Treasury to borrow. Of course, the problem was you could raise the ceiling, which they've done every time they've gone near it. But so we amended the Federal Reserve Act, and the Federal Reserve bought a bunch of treasuries. And how did they do that? They printed money. So the monetary spigots were opened up at that time, and it destabilized, to cheap money. When the war ended, they turned the spigots off. And then we had a bust. We had a little boom created by the Fed, and then we had a bust. And in fact, before I even talk about this, I want to just spend a few minutes on the business cycle, because this is another thing that Ben Bernanke doesn't understand. The recessions are not the problems. The booms are the problems. The recessions are the cures. See, the government creates a phony boom by keeping interest rates too low, by creating too much money, and you get a misallocation of resources, land, labor, and capital, and what happens is you have malinvestments, you make mistakes, and then eventually the bubble bursts and you have a recession, and that is the time where the market is trying to fix the mistakes that were made during the boom. The problem is when the Fed looks at the recession, it doesn't see that as the cure, it sees that as the problem, and it tries to cure it with more of the same monetary stimulus that created the prior boom. And so it interferes with the market's attempt to restructure the economy, and it makes bigger problems. And we're going to get into that later in this discussion. But so I'm going to go back to the 1920s. So the Fed turns off the monetary spigots, and we get this huge collapse. Stock market crashes, GDP crashes, unemployment skyrockets. And the president, Warren Harding, okay, what are we going to do? Well, he had a Secretary of Commerce, Herbert Hoover. Herbert Hoover was like, oh no, this is terrible. We need massive government stimulus. Now, he probably didn't use the word stimulus, but that's what he would have said today. He said the government needs to intervene. We need to stimulate the economy. The government has to help. We can't go through this. This is such a bad downturn. We can't let the market do this. We need decisive intervention by the government. And Harding was, no, we don't need that. We need the opposite. And what did Harding do in response to this downturn? He slashed government spending. Despite this huge decline, 17% drop in GDP, 12% unemployment, he cut government spending, right? The exact opposite of what the Keynesians say you have to do. And what did the Fed do? Absolutely nothing. The Fed didn't cut rates, it didn't ease. And what happened as a result of doing nothing? Well, within a year, the unemployment rate was cut in half. In 2 years, it was below 3%. It went from 12% to under 3% in 2 years. The stock market fully recovered everything it lost. Problem solved. The government didn't do a thing. Now, let's talk about the depression that Ben Bernanke wants to talk about. And of course, it's also important to note that this happened with the Fed. This huge decline happened with the Fed, not before. But now let's talk about the next depression. The crash, 1929. But also, I got to talk about one thing that Ben Bernanke didn't talk about. He talked about the crash in the stock market and the Great Depression, but he didn't talk about why we had a crash. Well, the reason we had a crash is because we had a phony boom that preceded that crash. And why did we have that? Well, that was because of the Federal Reserve. The Federal Reserve had interest rates too low for the second half of the 1920s, and they printed too much money. Now, why did they do that? Well, first, there was a little bit of an economic downturn in 1927 that the Fed wanted to, lean against with stimulus. So they tried to fight a contraction with cheap money. That's a very familiar story now. But also, you had a problem in the UK where there was a run on the British pound. The British were losing gold. They were on a gold standard too, and they had their interest rates too low. As a result, they were losing gold to the United States. People were getting out of the pound of the dollar. And so in order to make the dollar less attractive relative to the pound, they flooded the market with liquidity to try to drive down U.S. rates to try to stop the drain of gold out of Britain. And all of that liquidity went right into the stock market. And you look at a chart, look at stocks, and I actually have, in fact, I have this chart here somewhere. But you know what? I don't want to fast forward it because I want to talk about something first. I'll show you that chart when I get to it. But the stock market just took off, right? Now, in late 1928, Benjamin Strong, who was the head of the New York branch of the Federal Reserve, died. And he was the big proponent of this cheap money. He was buddies with a guy over there in the UK. And so when he died, the Federal Reserve recognized that there's this huge bubble. They made a big mistake, and they raised rates, which was what they should have done. And then the stock market bubble burst in 1929, just like it did, and the stock dropped sharply, you know, and we started a depression, just like the depression in 1920. Except this time it's different. This time the Secretary of Commerce, Herbert Hoover, is now the president. And now he can do all the things that he wanted to do in 1920, but that Warren Harding was smart enough not to let him do. Here is a quote, a famous quote from Andrew Mellon, who was the Secretary of Treasury under Hoover. Liquidate labor, liquidate stocks, liquidate the farmers, liquidate real estate, right? Liquidationist theory, right? Now, Ben Bernanke is presenting this as if that is what we did. But this is exactly what we did not do. This is what Andrew Mellon wanted Hoover to do, and Hoover said no. And Hoover, against that advice, was the most interventionist president in history. I mean, maybe he would be the modern equivalent right now of George Bush and the way he originally reacted to the financial crisis. And in fact, when Hoover ran for re-election, at his nomination for a second term, and you can look at his speech, he bragged about the fact that he refused to listen to Mellon, and that he did all this unprecedented stimulus. And it was all that stimulus that got in the way of the recovery. Had Hoover actually done what Ben Bernanke accused him of doing, there wouldn't have been a Great Depression, and there would have been nothing for him to study, or apparently not study, and it would have been over. And the interesting thing is, and this is where the parallels really get big, Roosevelt ran against Hoover because he was spending too much. He said, elect me and I'll balance the budget. He promised change. He said, this guy Hoover is a reckless spender. He's running up the deficits. Elect me and I'm going to cut spending and balance the budget. That is how Roosevelt ran, right? Like Obama, change. But when he won, what did he do? He took Hoover's policies and called it the New Deal and expanded them. He took the exact same policies and made them bigger, right? Which is what Obama has done. He's taken Bush's policies and just expanded them. And so the Great Depression was not caused for the reasons that Ben Bernanke. In fact, Ben Bernanke, his only criticism of the Fed is that they tightened too much, right? They tightened too much in 1931 or 1932. He doesn't criticize them at all for being too loose during the 1920s. He says they were too tight in the 1930s. And even his predecessor, even Alan Greenspan, admits that the Federal Reserve caused the stock market bubble in the 1920s. He says that. He wrote that it was the Fed's easy money policy that inflated that bubble. And the mistake was not raising interest rates, it was that they lowered them. And according to Ben Bernanke, if the Fed had just kept printing and printing and printing, that things would have been better. No, they wouldn't have. They would have been worse. If Ben Bernanke was in charge, who knows, we might still be in that depression. But his policy prescription is the exact opposite. And he didn't learn any lessons at all from the Great Depression. That's why he's repeating all these mistakes. Okay, then he went over the period of the 1960s and the 1970s, where here he gets it right a little bit, where he talks about monetary policy being too easy and the inflation rate was about 13%. Well, look, we're even easier now than we were in the 1960s. The question is, why is inflation not 13% now like it was then? And the answer is, well, it probably is. It's just that we're measuring it differently. You know, I had this conversation with Paul Volcker just kind of, a couple weeks ago, kind of, behind the scenes, because I said to Paul Volcker, I said, how do you feel having overreacted the way you did to the inflation that didn't exist back in the 1970s? And I said, well, what are you talking about? He asked, what do you mean? I said, well, if we had the CPI today back then, if we had the same methodology for calculating it, you would have seen that there was no inflation in the 1970s either. And therefore, there was no need for you to raise interest rates so high. But he was right in that, yes, the Fed was too easy during the 1960s, and during the 1960s, that sowed the seed for the 1970s. But the problem is we printed all this money, so we didn't get the big stock market crash during the 1970s that we had during the 1930s in terms of dollars, but we did in terms of gold. If you look at the decline in real terms, the stock market was worth about 20 ounces of gold in 1929. It bottomed out at about 1 ounce of gold in 1932. In 1966, the Dow was worth over 20 ounces of gold, and by 1980, it was 1 ounce of gold. So we had the same collapse. It just happened in gold terms, not paper terms, because the Federal Reserve printed so much money, which is the reason that prices rose so much during that period of time. That's why oil prices went from $3 a barrel to $30 a barrel, and that's why oil prices are rising today. It's not because of Iran, it's because of the Fed. It's because the Fed is printing up all this money. The price of oil is going up in dollars. It's not going down in terms of real money. You know, you can still buy a gallon of gasoline for less money than it cost in the 1950s. In the 1950s, you can buy a gallon of gasoline for a quarter. Today, you can buy a gallon of gasoline. It costs less than a quarter. But you have to have the same quarter. You have to have a quarter made of silver. So he was a little bit more accurate about this period of time. Okay, here's the chart I wanted to show you of the stock market. Here you can see that drop right down. That's the Depression 1921. You can see that 40% drop in the stock market, and then it immediately recovered. And if you look at the big ballistic move in the stock market in the late, like 1927 on, that's all that money, all that cheap money that the Fed put into the system, sent stocks up into the stratosphere. And then when they took the cheap money away, the market collapsed. And that started the Great Depression. But what really made it great was Hoover and Roosevelt interfering and not allowing the market to correct all the malinvestments that were made during that period of time. All right, now to go from the sublime to the ridiculous, it's Ben Bernanke's discussion of the housing bubble. All right, now Ben Bernanke, and is talking about the housing bubble. And according to Ben Bernanke, and you can see, you know, the chart of housing prices where they go ballistic. And maybe it's in the later slide, but I'm just going to talk about it and I'll show you the slides. Ben Bernanke says that there are some people out there who believe, for some crazy reason, that the Fed's low interest rate had something to do with the housing bubble. Right? Now, of course, I don't think the Fed had something to do with the housing bubble. I mean, if the housing bubble was a baby, the Fed fathered it and raised it and nurtured it. I mean, the Fed created it, right? It wasn't that they had something to do with it. They had everything to do with it. Now, Ben Bernanke claims that all the evidence shows that the Fed's policies had nothing to do with the housing bubble. Well, I don't know what evidence he's looking at, right? But all the evidence shows the opposite. So according to the Federal Reserve, the Fed had nothing to do with the housing bubble. Now, before I even discuss point by point his ridiculous arguments, think about the Fed's credibility on the housing bubble. In 2004, right, this is pretty serious into the bubble. In 2004, the Federal Reserve Bank of New York put out an intricate, detailed study because they wanted to study whether or not there was a housing bubble. So they put out a huge study, and they came back, and the conclusion of the Federal Reserve was there is no evidence of a housing bubble. Now, when this thing came out, I was shocked. I'm like, what is it? No evidence? What are they, blind? And you could read all the stuff I was writing back in 2004. I published it. I sent it out to hundreds of reporters. I gave them all the evidence that the Fed was ignoring of a housing bubble. And to me at the time, there was so much evidence of a bubble. It was so obvious that I thought, how could they possibly miss it? And I started to think, you know, maybe this is just pure like propaganda. I mean, the Fed is so concerned about the housing bubble, and they know people are figuring it out, that they're trying to lie to us so that we don't know about it, because the Fed wanted to maintain the cheap money in 2004. But if they knew there was a housing bubble and it was being fueled by the cheap money, they would have to raise interest rates. They didn't want to raise interest rates, so they had to pretend there was no housing bubble that needed to burst. So they trumped up this phony study. But those are the only two explanations. Either the study is phony and it was deliberately designed to be used as PR, even though the Fed knew there was a housing bubble, or the Fed is completely incompetent and they couldn't figure it out, even though it was the biggest bubble in our history. But not only the Fed itself couldn't figure it out, Ben Bernanke, you can go and look, even on YouTube, there's, the YouTube video, Peter Schiff Was Right, which has some of my TV appearances from, 2006 and 7. Well, there's another video. Not as many people have seen it. It's called Ben Bernanke Was Wrong. And I didn't do this one, but it has Ben Bernanke going on CNBC a few times in 2005 and 2006, specifically saying there's no housing bubble. It doesn't exist. Right? The housing prices are supported by solid fundamentals. And then Ben Bernanke went on to say, even if housing prices go down, it's not going to have any impact on employment. This is what this guy said. So let's get this straight. A guy who not only couldn't see the housing bubble, even at its peak, in fact, even after it burst, he still denied it existed. This is the guy that's telling us that the Fed didn't cause it? Well, if he didn't see it, how does he know? Maybe he caused it by accident. Right? He obviously doesn't understand it unless he's lying about it. And of course, if he's lying, then he has no credibility anyway, because he's just saying it. But if he actually believes what he's saying, well, how can we trust him? He obviously has a lousy track record. In fact, the guy knows so little about the housing market that even after the subprime crisis hit, what did Ben Bernanke say? Don't worry about it. It's contained. It's contained to subprime. He still didn't get it even that late in the game with all the evidence. He was completely clueless. I mean, either that or he was just giving out disinformation. But either he has no credibility or he has no competence. You got to figure out which one it is. But those are the only choices. So given the fact that Ben Bernanke didn't see the crisis coming, he has got no credibility as to offering an explanation. Contrast that to me. I wrote dozens of articles from 2004 to 2007 detailing in specifics exactly why there was a housing bubble, all the evidence of the bubble, why it was being created, and what was going to happen after it burst. And the reason that I knew this, and again, I'm not the only one. There are other people that knew it. And the reason I knew it is because I understood how his policy was creating it. The housing bubble was a function of the cheap money that was fueling it. Now, yes, it wasn't only the Fed. It was the Fed and Freddie and Fannie and the FHA, and it was the government guaranteed mortgages combined with the cheap money that did it. Right? It wasn't just the Fed, but the Fed was the principal actor, and then government through their sponsored enterprises was secondary. But that's it. But it's coincident. It's interesting too that not only does Ben Bernanke completely absolve the Fed from any responsibility, he also completely absolves Fannie and Freddie. According to Ben Bernanke, it's all Wall Street's fault. It had nothing to do. It's like, yeah, had nothing to do with him, right? Wall Street got drunk, right, according to George Bush, yet the bartender doesn't want to take any responsibility for liquoring everybody up. And then he lets Freddie and Fannie off the hook, too. Here's his evidence that suggests otherwise, okay? First, he says that the United Kingdom had a housing boom during the 20s despite tighter monetary policy than the United States. Yes, it was not as loose as the United States, but it wasn't tight. They had cheap money all around the world. That's what Ben Bernanke doesn't get. We had the reserve currency. We had interest rates too low. So the whole world followed in our bad example. That's why real estate prices were rising globally, because money was cheap everywhere. It wasn't just cheap in America. It was cheap everywhere. But it was cheaper here. And the difference is the UK didn't have Fannie and Freddie and the FHA, and we did. And so there was a huge difference here. Size of the bubble. Change the mortgage rates during the boom years seemed to be far too small to account for. Why not? I mean, the change in the mortgage rate was enormous, especially when you consider the fact that people were able to get adjustable rate mortgages. See, Ben Bernanke doesn't seem to understand that what fueled the housing bubble wasn't a 30-year fixed rate mortgage. It was the teaser rate on a 2 and 28 ARM. And where did that teaser rate come from? It was a gift from the Fed. The Fed lowered interest rates down to 1%, and that brought those teaser rates down. And here's the real thing that Ben Bernanke doesn't understand about Freddie and Fannie. Freddie and Fannie were the leaders in the charge to lower lending standards. What Freddie and Fannie decided to do for their conforming loans, because they have to guarantee the loans, and there is a certain income standard that Fannie and Freddie said, if you want to borrow a certain amount of money, your income has to be a certain percentage of your mortgage payments, right? Now, what Fannie and Freddie decided to do was fix that qualification to the teaser rate, not to the reset rates. So let's say somebody applied for a mortgage where for the first 2 years the interest rate was 3% and then it jumped up to 7%. And maybe that meant that for the first 2 years the monthly payments were $500 and then they jumped up to $1,500, right? The Fed was going to, Fannie and Freddie were going to guarantee that mortgage based on the borrower's ability to pay the $500 a month. They didn't care if the $1,500 a month exceeded his monthly income. They didn't care. They simply were guaranteeing mortgages based on the teaser rate. That's why these things became so popular, because you could borrow well beyond your ability to pay back the loan because the government was going to guarantee the mortgage anyway. So the government got the housing bubble going with cheap money and low lending standards from Fannie and Freddie. Only at the end did the private sector come in with the securitization market of subprime, but only because Fannie and Freddie were the biggest customers for Wall Street. Fannie and Freddie bought half the paper that Wall Street securitized. Without that big buyer, they wouldn't have securitized it all. And without Fannie and Freddie buying it, other people would have been too scared to buy it. But since Fannie and Freddie put their good government seal of approval on all this, junk, other people were buying it. But to say that Wall Street created the problem and it wasn't Freddie and Fannie, it's ridiculous. Freddie and Fannie was right at the center of this thing. Here's where he really goes off the deep end, too. He says, timing. Housing prices began to pick up in the late 1990s, before the monetary policy began easing, and so therefore it couldn't have been the result of their policy, plus it kept going up after they tightened in 2004. All right? Now, here's what happened. If you look at a chart of housing prices and the stock market, they really started going up, in the second half of the 1990s. And real estate prices really began their ascent in 1996, 97-ish. That's when the housing bubble started. But it's not as if the cheap money policies started in 2001. The cheap money is what fueled the entire stock market bubble that burst in 2000. The Fed under Alan Greenspan kept interest rates too low for the entire decade, particularly the second half of the 1990s. Every time there was a problem in the world, long-term capital management, Russian debt contagion, Orange County went bankrupt, Y2K concerned, whatever happened, Greenspan was there. In fact, he was so friendly to Wall Street, Wall Street came up with a name, the Greenspan put. Nothing can go wrong because Greenspan's got your back. So we had all this cheap money. A lot of it went into the stock market, but some of it went into the real estate market. So the real estate bubble began in the 1990s as a consequence of the Fed's cheap money. But it was obscured by the larger bubble in the stock market. And in fact, the stock market bubble was helping to fuel the real estate bubble because people were taking their stock market gains and using it to put a down payment on a house. In fact, a lot of people who were buying houses were cashing out options because they worked at a dot-com company and they became overnight millionaires and they went and bought a house. Because I remember I got married in 2000 and I was okay, the stock market's going to crash. I remember my wife at the time wanted me to buy a house. I said, I'm not going to buy a house because the stock market's going to crash and then real estate prices are going to come down too. We'll wait for the dip and then we'll buy. And of course, I was right. The stock market crashed, but the real estate market didn't. So when the real estate bubble burst and the Fed immediately did the wrong thing again by slashing interest rates down to 1%, they didn't really reflate the bursted NASDAQ bubble, but they perpetuated and accelerate the smaller bubble in real estate. And they really lit a fire under the real estate bubble. So real estate prices began to rise even more after the Fed slashed rates. But that doesn't mean that the Fed wasn't responsible for getting it going prior to that by having rates too cheap when they produced the housing bubble. Now, had the Fed not stimulated the economy in 2001 with cutting interest rates to 1%, the real estate bubble would have been snipped in its infancy. Real estate prices would have come down right then. They would have reversed those gains from 2006, from 1996 to 2000. We would have had a deeper recession, but we never would have had a housing bubble. We never would have had the financial crisis of 2008. That was the withdrawal from the Fed stimulus in 01. Now, when Ben Bernanke says we started raising interest rates in 2004, but real estate prices kept rising, well, they rose for 2 more years. The peak was in 2006. The problem wasn't that they raised them, it's that they raised them too slowly. They raised them at 1/4 point increments. That wasn't enough. In fact, I wrote an op-ed. It was either in 2004 or 2005, but I think it was 2004, in the Orange County Register. It was called the tender trap of adjustable rate mortgages. And in that op-ed, I said the Fed is raising rates too slowly. It needs to raise them aggressively. The longer they wait for aggressive rate hikes, I said the more people who are going to be lured into this tender trap of adjustable rate mortgages. These tiny increases kept the party going. And in fact, as rates were going up, it accelerated the demand for houses because people wanted to buy before the rates went even higher. So everybody was rushing in to buy and lock in these teaser rates so they can buy these houses. Had the Fed been aggressive, had we not went in a measured pace, had Alan Greenspan not raised rates 1/4 of a point every couple of months, had he just taken them up 200 or 300 basis points, moved them up, he would have nipped it in the bud. But, you know, it's one or two things there's one or two possibilities. Alan Greenspan at the time knew that the phony recovery was built on this housing bubble, and he didn't want to prick it. And so he was very careful to raise rates very slowly so as not to prick the housing bubble, to keep it going for political reasons, or he was totally oblivious and had no idea that there was a housing bubble. But obviously, if the Fed had known there was a housing bubble and they were acting responsibly, they wouldn't have raised rates by 1/4 of a point. They would have been far more aggressive. But the fact of the matter is they were too slow and they perpetuated this bubble. Think about all the adjustable rate mortgages that were taken out between 2004 and 2006. All of the worst paper was originated at that period of time. All the stuff that really went bankrupt. And it was because even though rates were 1%, so they went to 1.25%, 1.5%, 1.75%, 2%. Those rates were still ridiculously low. And so the Fed did this, and the reason that I was able to figure this out so easily, and again, the person who introduced me mentioned my speech in front of the Mortgage Bankers Association. Just go to YouTube and type in Peter Schiff Mortgage Bankers and listen to what I was saying in 2006. I said the same stuff in 2005. And then listen to what Ben Bernanke was saying and determine who has credibility. I mean, how did I know all this stuff was going to happen? Because I understood how the Fed's policy was distorting the market, how it was creating a bubble in their housing market. I understood how the entire economy was dependent on that bubble, on the spending of phony real estate wealth. I knew how leveraged the banking sector was to this phony collateral. I knew that when the bubble burst, the banks would fail, Fannie and Freddie would go bankrupt, and I also knew, more importantly, that the government would once again do the wrong thing, and the Fed would do the wrong thing, repeat their mistakes of 2001, which is exactly what they did. This is a slide that wasn't in his presentation. But anyway, so what did Ben Bernanke learn from the mistakes of Alan Greenspan? No, he repeated them. By lowering interest rates to 1%, we really inflated this huge real estate bubble that the Fed began to inflate when rates were too low in the 1990s. Did the Fed learn from its mistakes? No. Where are interest rates today? They're at 0. They're even lower than they were at any point in the Greenspan term. And he's kept them there for years, and he's promising to keep them there for years more. So you got to ask yourself, if the Fed did so much damage with a monetary policy that's not nearly as reckless as the one that we have now, imagine what is in store for the U.S. economy when we get the hangover when this stimulus wears off. And think about the Keynesian stimulus that we got from Bush with those budget deficits. The Obama deficits dwarf the Bush deficits. So unfortunately, just like the housing bubbles, the bursting of the housing bubble had more dire consequences than the bursting of the stock market bubble. The bursting of this next bubble, which I have described as a government bubble, you can see that in the bond market, in the foreign exchange market. When this bubble bursts, it's going to be much more disastrous. See, people think the U.S. economy is recovering. Well, they made the same mistake during the housing bubble. The Fed confused the housing bubble with a legitimate recovery. It's making the same mistake now. We're not recovering. We're just spending ourselves into a deeper hole. We're spending more borrowed money, and we're counting the spending as a growing economy. All that's growing is our debt. And remember, when we had this housing bubble, Ben Bernanke said it didn't exist. Well, now it's saying the same thing about inflation. The Fed is saying there's no inflation, there's no evidence of inflation, even though you can see the inflation everywhere. Well, there is inflation. Just like there was a housing bubble that the Fed didn't see, there's inflation that the Fed doesn't see. And eventually, interest rates are going to have to rise dramatically. And when they do, just like when they rose on the mortgage markets and all the subprime buyers couldn't afford to pay their mortgages when the rates reset, the U.S. government can't afford to pay interest on the national debt that's now enormous when the rates go up. Homeowners are going to be in trouble when their adjustable rate mortgages go up. The banks are going to collapse again, bigger than the last time when rates go up and their collateral evaporates and their income turns into losses. So unfortunately, rather than saving us, like Ben Bernanke's version of history, the Fed created the problem, they made it worse, and now we're in for a much greater catastrophe because of the Federal Reserve. And I got this chart up here. Ben Bernanke tried to talk about what a great job the Federal Reserve has done and how much better off we are with the Federal Reserve than without the Federal Reserve. Well, here's this chart. And you can see 1913 right there. This is prices. This is what happened to prices. So without the Federal Reserve, prices were falling. This is an index, a CPI index, where 100, and this is created by the Fed, 1967 is 100. So you can see here, at about 1800, you're around close to 40, and by 1900, you're closer to 20, right? So consumer prices were lower in 1900 than they were in 1800. That's sound money. That means money gained value over that 100-year period of time. Money gained purchasing power without the Federal Reserve. Because what did we have? We had deflation for over 100 years. Now, according to the Fed, deflation is the worst thing that you can possibly have. Well, the 19th century, by any way you want to measure it, was a more prosperous century than the 20th. We had much more economic growth. Living standards rose at a higher pace during that century than during the 20th century. And it happened with a gold standard, without a central bank, and it happened with deflation. Now, again, the government thinks deflation is some kind of pestilence that they've got to protect us from. It's not. It is the reward for capitalism. It is the way the average man benefits from capitalism, is that the cost of living goes down and his standard of living goes up. See, the government makes these phony arguments. They say, well, if we have deflation, nobody will buy anything because prices will be falling, and so the whole economy will seize up because people will be waiting for lower prices, and so nobody will buy. Well, that's complete hogwash. I mean, people buy cell phones all the time. People buy laptop computers. People buy plasma TVs. The price keeps going down, and they keep buying. In fact, the reason that people are buying is precisely because the prices are going down. It's falling prices that create the demand. The first cell phone that came out probably was about $2,000. Very few people bought it because it was so expensive. And then if you wanted to make a call, it was really expensive. What created demand for cell phones? The price came down. And as the price came down, people bought it. And the companies made more money. See, the other argument against deflation is that, well, no, the businesses will fail because they won't be able to make any profits with falling prices. They make more profits with falling prices because their costs are falling. And with lower prices, you get more volume. The cell phone companies are making a lot more money selling millions of cell phones at $50 or $100 a piece than they were when they sold a few thousand at a couple of $1,000s a piece. It's happened with everything. Any guy that owns a retail outlet knows that if you want to motivate your customers, you have a sale. You buy, So this is all cover. The Fed wants to create inflation. So in order to create an environment where inflation is considered good, the government has to first say that the opposite of inflation, deflation, is bad. See, and the Fed, and Ben Bernanke claims that the goal of the Fed is price stability. Well, if that was their goal, they failed miserably. See, look at the record before the Fed, and look at prices going through the roof. Now, this chart only goes up to 1975. I got another one. But look at how prices are skyrocketing once we get the Federal Reserve. Oh, and also, I want to point out, people want to say that you couldn't make any money. Oh, businesses can't make money under deflation, right? The greatest American fortunes were accumulated in the 19th century, not the 20th century. If you want to look at the 30 richest Americans of all time, self-made, adjusted for inflation, only 3 out of 33 were born after the Civil War. The other 27 were born before the Civil War, and of those 3, there's only 1 who was born after the Second World War. So people were able to make a tremendous amount of money in a deflationary environment. And in making that money, they created the American middle class. People were emigrating from all around the world to participate in this economic miracle of freedom, of sound money, and the government was tiny. In 1900, the government at all levels, state, federal, and local, spent 3% of the GNP. That's it, 3%. Today, that number is better than 40%. The government is more than 10 times bigger. as a percentage of the economy. That's why the economy is not as productive as it was. That's why we can't create wealth the way we did back then. And how did the government get so big? What enabled the government to grow that big? I would argue it's the Federal Reserve. Without the Federal Reserve, they never could have pulled it off, which is why they wanted the Federal Reserve. Here is this chart, right, that shows prices till today. So here we have, this is that index that is at 638. I mean, look at that thing going ballistic. Now, you know, if we could come back in a couple of years and put this chart up, there wouldn't even be enough room in this building. We'd have to bore a hole through the ceiling to show you where that chart is going to go. Because the Fed is on the verge now of destroying the dollar. Oh, here's another chart of consumer prices, 1913 to 2013. I mean, really, this graphically, I mean, this is without the Fed. That's price stability. Does that look like price stability to you? I mean, that's your definition of stability? I mean, going up like that? In fact, the Fed is now saying, it's actually admitting that its goal now is not price stability, right? Now its goal is inflation of at least 2% a year so that we don't accidentally fall into deflation. Well, look, this is a really scary thought. This is what we got when the Fed's goal was stable prices. Imagine what that line looks like when it says its goal is inflation. Right? I mean, it's going to be worse because if you really want stable prices, stable, in my mind, stable is like this, right? Well, that would mean some years prices go up, and then some years they go down. And that's how you get stability. Even if prices go up 2% a year, that's a lot of inflation over time. Stable prices is not 2% up every year. Stable is stable, right? So now we didn't have stable prices. We had escalating prices, and now they're going to escalate even more. And so where are we now? Because I got a few minutes, and what are these big mistakes? So where are we now? The Fed has got interest rates at 0. It is ignoring all of the damage being done structurally to the U.S. economy, just like you ignored the housing bubble. The trade deficit is once again skyrocketing, current account deficit, government deficits are exploding, and the Fed is sitting there with its foot on the gas, monetizing all this debt, because the Fed is afraid to allow the economy to restructure because of the short-term pain that would involve. But wouldn't we have been much better off had the Fed done that in 2008? What if we had not bailed everybody out, right, and let the chips fall, let some banks fail, let the markets restructure? Wouldn't that be better than piling on trillions and trillions of dollars of additional debt to grow the financial sector, to grow the government sectors, the sectors that are already bloated and too big? Meanwhile, the sectors that we need to attract resources, manufacturing, mining, wealth production, continue to atrophy. I mean, wouldn't it have been better to take the medicine? Wouldn't it have been even better to swallow that medicine in 2001? Had George Bush, not led us down this path, had he told the American public, hey, we had this huge stock market bubble during the 1990s. We made a lot of mistakes. We did a lot of foolish things. Now we're going to have a couple of tough years as we unwind those mistakes that we got under the Clinton presidency, under Greenspan. Yes, but no, we didn't do that. But the problem is we've run out of time here. This is a gigantic bubble that is bursting. You can see all over Europe, countries are now having to deal with their sovereign debt problems. Greece is the one that we're all talking about, but what is the difference between America and Greece? Because a few years ago, Greece was just as broke as it is now, but there wasn't a crisis. And the reason there wasn't a crisis is because the Greeks could still borrow money. Even though they were broke, even though they couldn't pay it back, interest rates were still low. At some point, Greece's creditors got nervous and they didn't want to keep lending, and that's when it hit the fan. Well, the same thing is here. We're just as broke. We can't pay our bills either. Right? That's why the Fed has to keep interest rates really low. Because if the Fed lets interest rates go up, then just like Greece, we have to default. We have to restructure. The U.S. government cannot afford to keep its commitments if rates go up. So the Fed keeps them down to prop up the government, to prop up the banks, but meanwhile, that makes the problem bigger. It makes the debt bigger, and it means the burden is that much higher when he eventually has to let rates rise, and the longer he waits, the higher the rates are going to have to go, and the bigger the damage. Now, some people will argue, well, we're different than Greece because Greece can't print money and we can. Yeah, that's why it's worse here, because that's what we might do. if we print money instead of defaulting, if the Fed prints money indefinitely because it doesn't want to let interest rates go up because of the pain that that's going to bring in, then we're going to have a currency crisis. We're going to have potentially hyperinflation, and the dollar will collapse, and Ben Bernanke will have created something far worse than anything that we endured during the Great Depression. And remember, when we embarked on this crazy Keynesian experiment, the government was tiny. On Hoover's last budget was like $4 billion, and I think Roosevelt doubled the size of government to $8 billion. It was still relatively small. And a lot of people say that, well, what really got us out of the Second World War wasn't the New Deal. It was the Second World War. That fighting the war, all that wartime spending is what got us out. It's actually the exact opposite. We got out of the Depression in 1946 when all the wartime spending stopped. Yes, a lot of people got jobs during the war, but they were jobs in the Army. They were jobs in factories making bombs. I mean, these weren't jobs that were producing goods and services that Americans got to enjoy. I mean, time was tough in America during the war. Everything was rationed. You could say that the worst part of the Depression was during the war. It was after the war, when we didn't have to waste all that money on war, on soldiers building bombs, when we had all those resources returned to the private sector, when the government slashed spending. That's when the recovery really began. Now, unfortunately, that's not what we're looking at now. We've got a Federal Reserve that's made policy mistake after policy mistake after policy mistake, and it refuses to accept any responsibility for the damage it's done, yet it continues to do it. I think the Federal Reserve, in contrast to what Ben Bernanke said, is probably the single most dangerous institution in America, and Ben Bernanke should be regarded as public enemy number one. And, I've seen him testify before Congress, and he'll even acknowledge when he's pressed that the most serious problem that we face as a nation is these big deficits. And he keeps saying, but this is not the Fed's fault, and it's not up to the Fed. He says that this is all political. BS. It's not political. It is the Fed's fault. How does Ben Bernanke think the government is getting away with all these deficits? It's the Fed buying up all the bonds. It's the Fed keeping interest rates artificially low. If the Fed wasn't buying any bonds and it wasn't buying any mortgages and it let interest rates go up, the government would have no choice. Spending would have to be slashed. We would have to allow the economy to restructure. The only reason that the politicians are not making the tough choices is because Ben Bernanke gives them an easy way out. But what are the ultimate consequences that we are going to be faced with, right? When the music stops, when the dollar crashes, when the bond market crashes, all of this is going to happen. I just did a debate earlier today on CNN International on this austerity versus stimulus, and people are saying, look at how Europe is suffering with their austerity, and we're doing much better under stimulus. First of all, they might have austerity there, but a lot of it is the wrong kind, and some of it is not austere enough. So I don't want to hold Europe up as the poster boy of what to do right. But they're making fewer mistakes than us. But that misses the point. In the short run, stimulus always feels better, right? If you're a drug addict and you check into rehab, and as soon as you get there, they give you drugs. Well, yeah, I mean, that's great. You're going to have a lot more fun than the rehab center that sticks you in a room and makes you go cold turkey. But a rehab center that's passing out drugs is not going to, rehabilitate anybody. It's not going to have a lot of success in curing drug addiction, right? So that's what we've got, right? And I even got Paul Volcker on that same conference to admit that he thinks, well, yes, Paul Volcker said the problem in the U.S. economy is that we have too much borrowing and too much consumption. He admits that, but then he supports the stimulus because, according to Paul Volcker, well, we need a little more of the hair of the dog that bit us, as if more cheap money and more spending is going to solve the problem. Look, it's like if you're overweight and if you're 300 pounds and the doctor says, look, you weigh too much, you're going to have a heart attack, you need to go on a diet, the solution isn't to first put on another 100 pounds because you don't want to just go cold turkey on all this. And then start losing weight, after you're 100. If you're too fat at 300, it's even worse at 400, and it's going to be even harder to drop the pounds. You got to drop them right now. Yeah, maybe it changes your lifestyle. Maybe you don't like exercising. Maybe you don't like eating salads and all that kind of healthy stuff. You don't want to eat junk food. You want to lie on the couch. But that doesn't get you healthy. And right now, everything we're doing as an economy, thanks to the Federal Reserve, stimulate. Ben Bernanke, right, one of his brilliant statements, he said in these lectures, the problem is we don't have enough demand. We got too much demand. Right? I mean, you know the old the expression, shop till you drop? We did it. We don't need any more demand. Ben Bernanke said the problem is households are not spending and borrowing as much as they did before the crisis. Of course they're not. They're broke. And the reason we had a crisis was because households were borrowing and spending too much. And why were they doing that? Because the Federal Reserve made it so cheap. That's why. So we don't want to return to the conditions that created the problem. We want to solve those conditions. The only way the economy is going to restructure and have lasting prosperity is if we do the exact opposite of what we did to create the problem. That means we need less spending. We need less borrowing. We need higher interest rates. The sooner the better. We need interest rates to go up, so savings go up, consumption has to go down, we have to invest more, we have to produce more, we have to export more, we have to shrink our trade deficit, we have to shrink our government, we have to repeal all these rules and regulations that are making us uncompetitive. Instead, we are doing the exact opposite of everything we need to do. In fact, if you wanted to create a blueprint to destroy America, all you have to do is follow the current plan. And the Federal Reserve is right at the forefront. Anyway, now I know I'm at the exact 1 hour mark. So I want to end my discussion and then open it up to questions from the audience, particularly from people who happen to have heard Ben Bernanke's lecture and who might want to question me about the differences in what we're saying. Yeah.
Let's we'll get a microphone here. First, a big round of applause. Am I on here, Meredith? Do I have to actually? There we go. Thanks for cramming 2 hours worth of information in the last 45 minutes. When you ask a question, please quickly state your name and then ask a question. Don't give a speech. Since I have the microphone, I'll ask the first question, which is there's been a tremendous advance in kind of literacy about the role of the Federal Reserve and central banking, and yet central banking remains pretty persistently popular throughout the world. Are there any examples of people stepping back away from that kind of centralizing ledge, or where do you see this proceeding next on a pragmatic point of view?
Well, I mean, you see examples in the market. I mean, look at the price of gold. I mean, when central bankers were really held in high regard, when people really trusted them, people didn't buy gold. I mean, gold was languishing in the high 200s in 2000. People were very convinced that gold was an ancient relic, that we didn't need it anymore, that we can trust the central bankers to keep a lid on money creation, to keep a lid on excess government. So that was really the heyday. The maestro, Alan Greenspan, people really, worshipped them, and they had a lot of faith in paper money and central banks. With gold at 1,700, it's been rising for 11 or 12 years in a row. That confidence is evaporating, and rightly so. And so you can see that. And all the central banks, if you look at the UK, look at the ECB, look at the Bank of China, look at the Bank of Japan, everybody's got interest rates at zero or practically zero. Even Switzerland has got them down there. And so there's no return on currencies. Everybody is printing money. All these governments are hopelessly in debt. They have two choices, default or inflate. Those are their only two choices, because paying their bills isn't even an option because they can't afford it. So if they're going to, either way, you don't want to own their bonds, because if they default, you don't get your money back. If they inflate, you get your money back, but you don't get your purchasing power back. So people are buying gold. We haven't yet seen it on a national scale where a country has, gone back on a gold standard. I think that's going to happen. I think central banks have gone from selling gold to buying gold. I mean, think about how stupid these central bankers are. What were the central bankers doing in the late 1990s when gold was $250 to $300 an ounce? They were all selling. What a stupid thing for them to have done, to sell their gold at those low prices. So now they're buying it back. But still, if you look at how much gold central banks own as a percentage of the gold that's out there, it's at historically low levels. And if you look at the reserves, the percentage of gold as a reserve relative to currencies, it's tiny. Some of the biggest countries, like China, that have $3 trillion in reserves, I forget what it is, maybe 3% of those reserves are gold. 97% of it is fiat paper. And all these BRIC nations, they're all way under-owned. But they're moving now, and they're moving in that direction to buying gold. You can even see here in the United States, various states are introducing legislation, preparing for an alternative to the dollar, trying to have gold circulate as legal tender within their states. So you can see this. And look at the price of oil. I mean, gasoline prices now, $4 a barrel. These are record highs seasonally. They're going to hit record highs this summer, $5, $6. And in a couple of years, it might be $10, $20. It might be $100. Who knows? If they keep printing money, prices are going to go up. Prices for everything are going to go up. Food, clothing. Eventually, even consumer electronics are not going to be able to stop that tide. So even if, in real terms, prices are going down because of efficiencies and economies of scale, even those prices are going to start to rise because that's how much inflation is in the pipeline and is being created. So as that happens, people are going to lose confidence. I think the dollar will lose its status as a reserve currency, and that's, really when it hits the fan.
Questions?
How you doing? My name is Chris Thiebelt, and I'm an intern at FreedomWorks. And I was wondering what you make of the argument that has been put forth by people like Krugman, as well as Bernanke and Greenspan, that the housing bubble was a result of a savings glut that emerged from China and other East Asian economies and was exported to America, which pushed down bond rates and then affected the mortgage
now
market.
Talk about putting the cart before the horse. I was addressing this problem, back in 2002, 2003, 2004. It wasn't the global savings glut. It was our trade deficits. What happened was we were spending all this cheap money. The Fed was creating all this money and putting it into the economy. The real estate bubble was creating all this purchasing power that people were tapping into through home equity loans. And what were they doing with the money that they extracted? They were buying stuff. And where was the stuff made? In China, in Japan, and other countries. And so we were exporting all of this currency. But since we weren't manufacturing things to sell to the nations that we were buying from, they had all this extra dollars. And so what did they do with all these extra dollars? They loaned them back to us in the form of buying treasuries. But ultimately, the treasury yields were so low that foreigners were not getting that good a return on these treasuries, and that created the demand for higher yielding mortgage-backed securities. But the problem was we had these enormous trade deficits that, because the dollar was the reserve currency, were being recycled into dollar-denominated assets, mortgage bonds, treasury bonds. Had the dollar instead been allowed to fall, which it should have, and these big surpluses not accumulated, we wouldn't have had this. But to blame our trade deficits on the rest of the world's surpluses is, again, it's getting it in reverse, right? And so they're looking at it. But I talked about this at the problem, and I said this was what was fueling the bubble, because what would happen is we would run these big trade deficits as a result of all the stimulus, and then our trading partners would recycle the money they earned back into our mortgage market, which would bring interest rates down even more, which would create another wave of refis and home equity extractions, which we would then take to Walmart and buy more stuff to send more dollars abroad that would come right back. And I said at the time, and you can read it, I described it in Crash Proof. I described this virtuous circle of how it worked, but that it was going to go in reverse once it burst. And in fact, it's amazing that Europe never really blamed us for this financial crisis, because how did Europe get all this bad paper? We sold it to them. We packaged it up and we sold our junk bonds, mortgages, all around the world because we were borrowing money. There was a glut of dollars from our trade surpluses, but if the Fed didn't have interest rates down so low, we wouldn't have been consuming more than we produce. We would have had to save more. Right? We would have had to have produced more. We wouldn't have all these imbalances. So you can say, yes, foreigners are partially to blame for not letting the dollar tank. Right? They should have let the dollar collapse. They should have said, the dollar can't be the reserve currency anymore because it's not backed by gold. You have all these trade deficits, and they should have let the dollar sink. Instead, foreign central banks tried to prop up the dollar, and so to do that, they were buying up all these dollars, and then we were recirculating them back into these bonds. But again, you can't blame it. You can say, yes, they're partially to blame for not letting the dollar tank. But of course, if they let the dollar tank, then we would have a real crisis in America right now, which we're going to have eventually. And as far as I'm concerned, the sooner the better. I think that foreigners are not helping us by delaying the pain. It's like, a drug pusher giving you, free drugs. Yeah, I mean, you think he's doing you a favor until, all of a sudden you don't get the free drugs anymore. And that's what's happening now. I mean, we're living above our means because of this, but it's going to come to an abrupt end. And it's going to be a very, very painful process to try to restructure this economy after years and years and years of being able to consume based on printing money, because that's going to stop. Yeah.
Well, we have one question from the Facebook page before we move back up front, and that is, how do you see the Federal Reserve being phased out of our economy?
Well, I don't know if it's going to be phased out. I mean, it's a... But what I think we should do, at least, is return the Federal Reserve to its original mission. Right? Don't let it buy government bonds. Let's bring it back to its initial limited function. Where the Federal Reserve notes are backed 100% by commercial paper and 40% by gold, and let's have real money again and follow the Constitution. But if we do that, maybe we can gradually phase out the Fed. But a lot of people think, how can we go back to a gold standard? And of course, I don't think of it as going backwards to a gold standard. I think it's going forwards to a gold standard, because we went backwards to paper. The founding fathers were forward thinking. They knew that paper money didn't work, and so they were progressive. They put us on a gold standard. We forgot about that, and we reverted to a failed system of fiat money. So we need to advance again to a gold standard. But think about this. We were able to take the country from a gold standard to a fiat standard. We went from a dollar backed by something to a dollar backed by nothing. To me, that seems like a harder transition to make than to go from a dollar backed by nothing to one that's backed by something, right? To something that has real value. It's just not a piece of paper where there's some limit on the ability to just create it out of thin air. So I think it's a transition that's very doable, and that it will ultimately happen. Right now I'm advising people, don't wait for the official return to the gold standard. Buy your gold now, because when we're on a gold standard, it's going to be a lot more expensive.
Hello, Mr. Schiff.
Yeah.
My name is Byron Sanford. If we implemented tax increases and spending cuts, which European countries are doing right now, what negative consequences do you see as a result of that?
Well, I see no negative consequences to spending cuts at all. Tax hikes, it would depend on the type of tax hikes that you're envisioning. I mean, I do think that it is better for the government to run on revenue than run on debt, right? So increasing revenue through taxation in general is better than increasing revenue through borrowing or printing. So, but I don't think the problem in America is that the government doesn't collect enough in taxes. I think the problem is that it spends too much. So I want to resolve these imbalances with radical and drastic reductions in government spending. That is the best way to attack the problem. But of course, we need to let interest rates rise too. Until we get higher interest rates, we're never going to get at these real structural imbalances, because it's because of price fixing. We need a market-determined interest rate, not a interest rate that's determined Soviet style, by a central planning division that just picks an interest rate out of the sky. But what's also important when it comes to taxation is that we need to reform the way the government collects taxes. That's a key part. Even if we're going to collect more revenues, right, which I would prefer not to do, but if we're going to balance the budget through a combination of higher taxes and lower spending, we need to reform the taxes so that the new taxes are coming off of consumption and spending, not off of savings and investment and production. So I don't want to tax people for working and investing. I want to tax people for spending their money. And yes, people say, well, if you do that, then the rich are going to get off the hook. No, they're not going to get off the hook. The rich spend a lot of money. I mean, they're rich. They buy a lot of expensive stuff so they can pay taxes. But if a rich person earns a lot of money and doesn't spend it, why should we tax that money? Because he's not enjoying it. He's not spending it. What is a rich person doing with the money he doesn't spend? It's being invested. It's growing the economy. It's producing goods. It's creating jobs. So any money that the government takes from a wealthy person that wealthy person wouldn't have spent directly diminishes economic growth. It directly diminishes employment. If you think that you create economic growth and create jobs by taking money away from entrepreneurs and business and giving it to politicians, right, a government, right, there is no historical evidence that that works. In fact, all the historical evidence is the opposite. Right? When governments are in control of resources, they're squandered. you don't get economic growth. You get widespread poverty. So we want to leave wealth in the private sector so it can raise our living standards and create jobs. And it all gets caught up in demagogues or, well, but the rich aren't paying taxes. Okay, fine. What are they doing with their money? Right? They're investing it. Tax them when they spend it. If you buy, you buy something, you pay a tax. And so we need to move the tax code in that direction. If we just do what Obama wants to do, raise taxes on the rich, it's probably going to backfire. I would fall into the category of rich. And right now, what are my taxes? I'm paying 35% federal income tax plus 2.9% federal, Medicare tax. So that's 38% of my money, plus state of Connecticut, 7%, factoring, so that puts me at over 40% of my total income. Is because 95, 99% of my income is taxed at the marginal rate. So that's over 40% of my income right there. And that doesn't count what I pay in property taxes, sales taxes, Social Security taxes, corporate taxes, all kinds of hidden taxes. I'm already probably about 50%. How much more am I going to take? Are they going to take it up to 55%, 60%? How many people are even going to work under that type of confiscatory rates of taxation? And which means the government might end up getting nothing. It's better to get 20% of something than 70% of nothing. And more importantly, it's not only that. What about the jobs that are destroyed or are never created? Because the entrepreneurs don't have that capital to grow their businesses. They sent it all to Washington. So, trying to tax people who are already overtaxed is not going to do it, And meanwhile, half the people in the country aren't even paying any income taxes. Yes, they pay Social Security taxes, but, they think that raising income taxes doesn't cost them any money. Well, maybe it costs them their job because they can't get a job because the capital needed to provide that job was sent to Washington instead. So we created all that wealth. I talked about the 19th century and all the wealth that was created. There were no income taxes at all. Nobody. Those wealthy men that created all these fortunes that grew this economy paid no federal income taxes. They paid no state income taxes. Nothing. So we need to move more towards that model of free market capitalism, not try to continue this broken model.
Do we have questions from the Bernanke class crew here who wants to take their lumps? Here you go.
Thank you, Mr. Schiff.
Yep.
My name is David Pomeroy. I had a question for you about the gold standard, and I was wondering, some of the charts that you showed seem to be showing a simplified version of the gold standard's record in the 1800s, having it smoothed out over the long term, but don't show the wild short-term fluctuations, which are in excess of 5% inflation and deflation.
Yeah, well, I don't know what you can see from that slide, but there were periods of time under a gold standard where you saw that, but it always coincided with a period of time where we kind of temporarily veered from it, such as the Civil War, where we introduced for the first time greenbacks into circulation, and we did have an inflation that ran with the Civil War. When the war ended and the notes came out of circulation, prices resumed. So what you're looking at is a long-term trend that was like this. And yes, there were bumps, but you're looking at a 100-year chart to show the overall direction of prices, which was down. And you look at the chart of the 20th century, particularly the second half of the 20th century, where we are now, you're looking at a movement like this.
So, while that is true, there were some pretty variable fluctuations in the 1800s, and while it was long-term stable, it wasn't short-term stable, whereas now it is not long-term stable, but it is more short-term stable.
Well, I don't know how you can call it short-term stable if you consider stability going up every year. The goal of the
short-term
Fed,
instability that I'm talking about is when it goes up 5% inflation and then down 5% deflation 2 years later. So that's pretty unstable compared to today's standards.
I don't know. As far as
my
I'm concerned,
for you is why are the short-term fluctuations more desirable than the long-term stability of?
Well, I don't think we have stability. I don't think creating perpetual inflation gives you stability. And as I said, if you look at the economic experience of the 19th century, look at the increase in living standards, right, during that period of time compared to today, it was much stronger. We produced more economic growth. We raised living standards for more people higher. Even with whatever those short-term fluctuations were, they were not nearly as problematic as what we've got now. We've eviscerated the middle class that was created with limited government and sound money. And now Americans are all in debt. The average American has a negative net worth now. He's broke. His share of the national debt dwarfs whatever minimal amount he has in savings or in home equity. So the economy is struggling under the weight of all this government and central banking. And we haven't even experienced the complete end result. The real crisis, the real day of reckoning from this experiment with fiat money, that's not in our past yet. That's in our future. I mean, it's going to get a whole lot worse. And then a lot of people are going to see exactly the damage that has been done by central bankers and government.
Thank you very much for speaking. I think we all
got 10
appreciate
minutes.
it. My question is, returning to the gold standard, as you mentioned, no country right now is on the gold standard, but you said that you think that in the future countries will go back to the gold standard.
Yeah, I mean, when we left the gold standard in 1971, Richard Nixon said it was temporary. I mean, that's what he said. I mean, it wasn't his intention.
So just to finish the thought. So looking back, many countries have been on the gold standard in the past, and every single one of them has ended in the country going off the gold standard. In the UK and in Germany and during the Great Depression, it was because they just ran out of gold.
Well,
they didn't have enough gold to cover it. So what makes you think that if a country were to return to the gold standard in the future, they would be able to maintain it and it just wouldn't end in them going off the gold standard like it has in every other circumstance in history?
Yeah, well, the reason, it's not that they run out of gold. See, they don't want to allow deflation. They don't want to allow prices to adjust to the quantity of gold.
They would have.
So politicians, they don't run out. So politicians don't like the gold standard for the very reasons that Bernanke laid out. It prevents them from selling snake oil to their constituents in exchange for their votes. The politicians want to pretend that they can spend money to solve problems. The gold standard is in their way. So it's the politicians that want to remove the gold standard. Ultimately, it's people that are going to want it back. People want real money. People want sound money. Now, the last country that went off the gold standard was Switzerland. I mean, they held out the longest, but one by one, all the politicians followed our example. We led the world off the gold standard. We're probably going to lead them back, not necessarily because we adopt the gold standard first, but because we destroy the dollar and their reserves, and they have to replace it with something. And so once we've destroyed the dollar, the question is, what does the world do to replace it? Are they just going to take the euro? Are they going to take the yen, the RMB? Or are they going to go back to the dollar? Remember, the reason we were able to sell the world on the dollar as the reserve, as opposed to gold, because everybody was using gold, and we said, hey, use the dollar instead of gold. And basically what we said is we own all the gold. We've got 90+% of the world's gold anyway. Where did we get all that gold? We sold products and they paid in gold, because they didn't have the products. They didn't manufacture like we did, because they had bigger governments than we did. So we had all the gold. We were the world's biggest creditor nation. We had investments all around the world. We had massive inflows from our foreign investments. We were by far the wealthiest creditor nation. And we said, look, hold dollars. The dollar is as good as gold. You don't need gold. You've got the dollar. You can have your gold whenever you want it. Just bring $35 to the Treasury and we'll hand you an ounce of gold. In the meantime, you can get paid interest on your dollars. You don't get paid any interest on your gold. So we convinced the world, based on the strength of our balance sheet, based on the dollar being as good as gold, to take the dollar as the reserve. So when this whole thing collapses, the most likely thing is that we go back to the way it was before the dollar became the reserve currency, not that we simply replace some lesser flawed fiat currency for the dollar.
Can I follow up?
Yeah.
Just when you said that the United States had all these foreign investments that had gold coming into the country, inflows of gold during that period.
But we had income from our foreign investments.
Right. Of course. So if you kind of follow that to its conclusion, which happened during the Great Depression, if the United States is so strong, if any country is so strong, that there's continuous inflows of gold into the United States, eventually the United States will have all the gold, and nobody else will have any gold. They'll run out. And then we'll end up off the gold standard.
No, because what's going to happen? Then we're going to have to start using our gold to buy some of their stuff, and the gold will flow back out. But because. Well, look, if the world ran out of gold, theoretically, right? Well, then we would just produce stuff for ourselves. If we're going to export something, the world has to pay for it. Right? So it isn't a problem. The problem is the fiat standard. I mean, gold standards have worked historically for hundreds of years. I mean, the founding fathers knew this. These were smart guys. They put us on a gold standard for a reason. They studied history, and unlike Ben Bernanke, they not only understood it, but learned from it. And so they put us on a gold standard. And it served us very well. We were a tiny country. We were an afterthought to Europe in 1789. We were a few million people. Here in the New World. Yet we created a society in just a 100-year time period that we created a standard of living well beyond anything in Europe. How did we do that? We did that on a gold standard. We did that with no government, with a tiny government and freedom. We were freer than Europe, and so we prospered more than Europe. You know, we came in with the fiat standard. You know, we started in 1913, but we didn't really go off it until 1971. Look at the disastrous result. Look at the collapse of the value of our money. Look at skyrocketing prices. I mean, look at before the Federal Reserve came into existence in America, if you were a man in this country and you didn't even have a high school degree, you could get a job. Your wife could stay at home. She'd have to get a job. You can support her. You can have 4 kids, right? You can save for your retirement. You can buy things. You had a great standard of living. Now, if you're, you know, there's no way. I mean, the average man can't, even with a master's degree, his wife has a job. And they have to delay even having 1 kid until they're in their late 30s because they can't afford to have them because they're drowning in debt. And, you know, and even when they have kids, it's 1 or 2 kids, and they're struggling, and they have no savings, and they're deep in debt. So we have destroyed the middle class that freedom and the gold standard built, and the Federal Reserve is a big reason for that.
My name is Troy Vincent, and I agree that hedonics and geometric weighting, these things have heavily skewed the CPI over the years and have changed really, you know, our view of inflation. But given the amount of excess reserves that are now sitting on the balance sheets of many financial institutions, where basically this money isn't being lent out, it's just being pent up in these financial institutions, it's now exceeded trillions of dollars. I mean, do you think that eventually the Fed will try to intervene and try to force the banks to lend that money out?
Well, it is being loaned out. I mean, the banks are buying bonds. They're buying treasuries. They're buying mortgage-backed securities. So the money is being loaned out. The problem is it's not being loaned out in a productive manner. It's not being loaned out to entrepreneurs to make capital investments to grow the economy. It's financing trillion-dollar budget deficits. It's financing inflated housing prices. That is the problem. And yes, you know, the way we measure inflation is all government, you know, propaganda. And again, just like Ben Bernanke denied there was a housing bubble, even though it should have been plain as day, now he denies there's inflation. But when the Boskin Commission was convened back, you know, in the 1990s, they had a stated goal. According to that commission, the CPI overstated inflation, meaning that they thought the numbers were too high. So they were going to fix the problem. And they deliberately tried to find a way to get a lower number. See, it's not a conspiracy. That's what they did. And so they did all kinds of things so that the number would be lower. And now it is lower. But it's not because inflation is lower. It's because we're measuring it differently. And, of course, you know, the Federal Reserve, all they like to look at is, you know, the personal consumption expenditure index, which is the most irrelevant of all, because really what that measures is survival, not the cost of living. It's the cost of surviving. Because there, you know, if the price of steak goes up so much that you can't afford steak anymore, so you buy hamburger instead. But hamburger's also gotten a lot more expensive. But it's all you can afford. Even if the hamburger is more expensive than the steak you used to buy, the government's going to say, oh, that's a price cut. Because, look, you're saving all this money because you're buying hamburger, right? Then, of course, you can take the same argument. What if the price of hamburger gets really expensive, so I have to buy dog food, right? All right, well, there's no inflation because I'm still eating. You know, this, you're shaking your head, so maybe you think I got something wrong.
I work for the Bureau of Labor Statistics, so for the CPI, actually. So.
Yeah, but that's how they do it for the personal consumption expenditure. They do substitution.
Well, yeah, because you know, the example that you give about substituting steak for hamburger, actually they're in different categories, ELI categories, different categories. So steak and hamburger wouldn't be in the same. When there's a substitution, it wouldn't be.
But they do substitute. But if the price of something goes up, they'll kick it out and they'll substitute something where the price didn't go up.
I mean, the way we do is we have actually people who go into stores and they actually go and look at the item. If the item is not there, they look for another item that goes into that category. And if it fits that category, then we substitute.
Yeah. And what about with hedonic? Because I often hear where the government is going to say, when the price went up, they're going to say, well, the quality went up, and so they're claiming that the price went down. But in my experience, most of the things I'm buying, I'm seeing the quality going down. where they're substituting cheaper ingredients, they're using lower quality inputs, they're shrinking the size, things like that, and they're doing that instead of raising the price. Is the government going in and saying, gee, you know, you used to go to a restaurant and the restaurant used to charge, you know, $10 for the salad, and now they still charge $10, but it's half the size? Right? Are they going and saying that's a price double?
What's happening now is that we notice that producers and, you know, people who actually produce the products, they're actually downsizing, as you said. They're downsizing on their products, but we do register those changes in downsizing when we enter the prices.
It doesn't. It certainly doesn't appear that way from the numbers.
I work in the collection part of the CPI, so I really don't know what's going on. At the end of the,
because I talk to people who, small business owners, and business owners are usually, you know, they watch their prices, their input costs very closely because they're trying to make a profit, so they have to know what their costs are. And everybody that calls my radio show, no matter what their business is, they've got the same gripe. My costs keep going up. Prices are going up. And these are big increases. And they're all businesses that are totally unrelated.
Well, that's true. I mean, costs are going up.
But so why isn't that reflected?
Well, you have to understand that, I mean, a lot of people have this misconception. I'm not exactly, you know, the most knowledgeable person in the CPI because, you know, I'm only 25 years old, so I started working about 2 years ago there. But the CPI measures the average change of a basket of goods. So it doesn't measure one specific good, you know. So,
but the basket is changing. The basket isn't even static. But the thing is, costs are prices. They're the same thing.
Yeah.
It just depends on your perspective. But one person's cost is somebody else's price.
Well, the basket, the CPI measures the average of all the items included, not only one item. That's why an employer might say.
Well, that's the core. When they take energy and food out. But you know, the bottom line is, see, the problem is inflation is not rising prices. Inflation is an expansion of the money supply.
I do agree.
So the government isn't even measuring prices. They're measuring inflation, rather. They're measuring the effect of inflation. But the fact that the Fed is creating inflation shouldn't even be debated. Quantitative easing is just the Fed's name for inflation. They just don't want to call inflation inflation because then we'll know what it is. So they call it quantitative easing because it sounds better than inflation. But that's what it is.
I'm not censoring the Bureau of Labor Statistics. We're just up against a hard deadline. I want to thank especially Peter Schiff, Andrew Schiff as well, FreedomWorks, Matt Kibbe, Students for Liberty, and all of you for coming out here and having a robust discussion on the Federal Reserve and freedom, damn it, freedom.